All right, I think we have critical mass and we can go ahead and kick off. Thanks so much to folks for being so timely, and welcome to today's lender exchange call on green, social, and sustainability bonds. The headline of today's call is Reaching New Investors Through Sustainability Bonds. But as we're going to discuss today, there are actually a lot of different motivations for issuing these types of bonds that we're going to hear about. So if you're on OFN CDFI Connect platform, you might have seen today that their latest members in the news post was about sustainability bonds, and I did not even coordinate that. In case you missed that post, it was announcing that Blue Hub Capital recently completed their first public debt offering. That was a $75 million sustainability bond. So that was really exciting to see. And clearly this is a really exciting space that's emerging. So thanks to everyone for joining us today to talk about it. We do have a big group that's going to be joining, so everyone is muted for right now, but we are going to have a traditional kind of Q&A toward the end of this call. But if you do have a comment or a question that comes up relevant to what's being discussed, then please do put in a comment in the question box or go ahead and raise your hand. And Liz or I, the moderators, will unmute you and we would welcome that. So please do raise your hand. And just so everybody knows, the call is being recorded, so you will get a recording of it in the coming days, and we'll also send around a PDF of the slides. All right, so in terms of presenters today, again, as I said, the call is going to be moderated by myself, Bettina Burgu. I'm with the Sustainability and Affordable Housing Lender Learning Network, and also my colleague Liz Rogers with CEI will be moderating. We're going to start off with Atalia Howe. She is with the Community Preservation Corporation. She is going to give us some background on different bond designations and the elements of an impact bond framework, amongst other things, to just set the stage for us. So I appreciate her doing that. Then we're going to hear from Christina Travers with the Low Income Investment Fund. She's going to provide some insights on what's driven LIFT's sustainability bond issuance and the results of that issuance. Then we're going to hear from Anna Smukowski. She is with the Local Initiative Support Corporation and is going to provide some thoughts on how to choose between different bond designations and her thoughts on the different opinion providers that are out there. And then lastly, we're going to hear from Melanie Crocco, also with Community Preservation Corporation. They recently issued their first sustainability bond. We're going to hear about how that bond fits into their broader sustainability platform and lessons learned from that issuance. So a lot to cover today. So I will just very quickly say that I am part of the Energy Efficiency for All initiative. We're focused specifically on efficiency and healthy building materials in affordable housing. And as part of that project, I coordinate the Lender Learning Network. So I welcome your going to our website or reaching out with any questions about it. And Liz, I'll send it over to you for some comments about your group, or our group.
Yeah, thank you. Thanks, Bettina. This is Liz Rogers, and I'm from Coastal Enterprises, CDFI in Maine. And I lead the Communications and Awareness Committee of the CDFI Climate Crisis Working Group. The group was formed in October 2019 to help the CDFI industry incorporate a climate and sustainability lens in its work. And with currently over 130 participants representing 90 organizations, the working group has kicked off its efforts with monthly calls around knowledge sharing and has formed committees to deep dive into actions and collaborations. And you can see the committees shown in the slide here, representing areas including growing climate-oriented products and services, plugging into local ecosystem efforts, mapping the CDFI sustainability ecosystem, developing policy and advocacy efforts, and increasing awareness and communication strategies. We're also hoping to partner with banks, foundations, government, developers, and investors. So there's a group working on that as well. We are excited to co-host today's call, especially given how important it is for CDFIs to have access to capital dedicated to ESG goals so that they can be leaders in financing the climate and sustainability needs of low to moderate income communities. And we welcome your participation in the Climate Crisis Working Group. If you're interested in participating, please email Jen Leibowich, who's our working group chair, and her email address, I can put it into the chat box, but it's jen@mainstreetlaunch.org. Thank you, Bettina. Thanks for letting me share that.
Absolutely. Yeah. Thank you, Liz. And that is a good idea. If you don't mind putting Jen's email in the chat box, and then we can include that in the follow-up as well, along with the link to the recording. All right. So over to you, Atalia.
Wonderful. Thank you, Bettina. Can everyone hear me okay?
Yes.
Great. So you can switch to the next slide.
Are you seeing the setting the stage?
No, not yet. Still seeing the CDFI Climate Crisis Working Group slide.
Oh. All right.
There we go. Now it's up.
Okay.
Fantastic. So I'm going to dive right in. I know we've got quite a bit to cover today. So yeah, I'll kick it off. So the transition to a sustainable, low-carbon economy requires increasing investments and scaling investments that provide environmental and social benefits. And as we'll see today, the bond markets, through green, social, and sustainability bonds, can play an essential role in attracting private capital to finance these global needs. These bonds are often referred to as labeled bonds, are fixed income securities that differ from conventional debt instruments only in that they direct capital to ventures that are expected to yield environmental and social benefits as well as profits. The green bond principles and social bond principles, as well as the sustainability bond guidelines, are voluntary process guidelines that recommend transparency and promote integrity by clarifying the approach for issuance of these types of bonds. The International Capital Markets Association, or ICMA for short, is the organization that develops and oversees these guidelines. ICMA is a not-for-profit membership association that provides services and assistance to participants in the international capital and securities market. The mission of ICMA is to promote resilient, well-functioning debt securities markets, which are essential to fund sustainable economic growth and development. As we'll see on the following slides, the four components of both the green bond principles and the social bond principles, as well as the sustainability bond guidelines, include the use of proceeds, the process for project evaluation and selection, management of proceeds, and reporting. And again, we'll dive into those more on the following slides. So just taking a look at green bonds. Green bonds are any type of bond instrument where the proceeds will be exclusively applied to finance or refinance, in part or in full, new and or existing eligible green projects. And really, ever since the market's inception, there's been a pretty animated debate about what is green. And so we can kind of see a few of these categories here. There are others, but there is a pretty broad acceptance of what constitutes green projects. So we've got everything from renewable energy, which includes production and transmission infrastructure, energy efficiency, such as in new and refurbished buildings, and green buildings meeting regional, national, or international recognized standards. There's also, which is not included in this list, but there's pollution prevention and control, which also includes reductions of greenhouse gas emissions. So the labeled bond market has really expanded beyond green bonds. Sustainability and social bonds have been around for a few years, but they really kind of started to take off about 2 years ago. And social bonds are directly aimed to address or mitigate a specific social issue and seek to achieve positive social outcomes, especially but not exclusively for a target population. And some examples of target populations include, but again are not limited to, those living below the poverty line, those excluded and or marginalized populations in our communities, and vulnerable groups, including as a result of natural disasters. So again, a pretty broad acceptance of what constitutes these types of projects and target groups. And then sustainability bonds are bonds where the proceeds will be exclusively applied to finance or refinance a combination of both green and social projects. And for the full list of eligible project categories, you can visit ICMA's website to review the green bond principles and the social bond principles in more detail. So Bettina, if we can switch to the next slide. I think there might be a slight delay, but I will jump in. So just kind of diving into the green bond principles. Again, as I mentioned, these are voluntary process guidelines for issuing green bonds. The use of proceeds is kind of the cornerstone of a green bond and how it's used. And you really have to ask yourself, is capital being directed to ventures that are expected to yield environmental benefits?
Talia, are you seeing my slides now?
Yes, I am.
Okay, great. Sorry.
I think there's just a slight delay, but we do get there, so that's good.
Okay, good.
In terms of process for project evaluation, the green bond principles encourage a high level of transparency and recommend that an issuer's process for project evaluation and selection be supplemented by an external review, and we'll cover more on that a bit later in the presentation. In terms of management of proceeds, essentially we're looking at the formal internal processes linked to the issuer's lending and investment operations for green and social projects. And in terms of reporting, issuers should keep readily available up-to-date information on the use of proceeds until full allocation. You can skip ahead. So in terms of the social bond principles, I'm not going to drain these bullets. They're very similar in terms of project evaluation and selection, management of proceeds and reporting are the same as for the green bond principles. Again, these are voluntary process guidelines for issuing social bonds. And really the key difference here between the green and social bond principles is the use of proceeds. So for social bond principles, the question is capital being directed to ventures that are expected to yield social benefits? Okay, Bettina, we can skip to the next. So that kind of brings us to sustainability bond guidelines. The common four core components that we just covered on the last two slides for green bond principles and social bond principles also apply to sustainability bonds if projects have characteristics of both green and social bond principles. I think it is important to note that the project impacts, however they're branded, are reviewed against both green criteria and social criteria for all project categories to eliminate green projects with potentially harmful social impacts and vice versa. Great, thanks. You can switch to the next slide. So just beginning to kind of look at the market for these types of labeled bonds, there is a growing class of investors looking to generate environmental and social impact as well as financial returns. In other words, to do well by doing good. As a result, demand for green bonds, social bonds, and sustainability bonds has increased exponentially since the first green bond issuance in 2007. Moody's projects that the market is expected to reach $400 billion in 2020, up from $323 billion in 2019. So that's close to a 24% increase in 1 year, year on year. The fastest growth is occurring among sustainability bonds, which really reflects issuers' desire to highlight their wide-ranging sustainability initiatives. So again, not only focusing on green projects and green categories, but also on social impacts as well. Despite this growth, this really quite impressive growth in the past decade, Impact labeled bonds still only represent a combined 5% of global bond issuances. So there's still a lot of room to be made. Great, we can switch to the next slide. So just looking at issuances, Europe has historically led the way in terms of labeled bond issuances and continues to do so. This is really a result of the regulatory market for green investments and the European Union's emissions trading system, which is the cornerstone of the European Union's policy to tackle climate change. In 2019, issuers in Europe accounted for approximately half of global green bond issuances, followed by North America and Asia Pacific. Europe also led the market in terms of social and sustainability bond issuances, accounting for 57% and 37% of issuances, respectively. Taking more of a sector approach, financial institutions worldwide issued the majority of social and sustainability bonds. That said, there are a wide range of corporates that are engaging more and more in this space, including Apple, Unilever, and Bank of America, and we're likely to see that trend continue as the push for a decarbonized economy continues to accelerate. Fannie Mae has been the world's largest issuer of green bonds to date, issuing over $50 billion in green bonds between 2012 and 2018. Just looking at use of proceeds now, and at the trends in terms of what categories of projects are being supported through these investments. In terms of green bonds, energy and buildings, so making buildings more energy efficient and low carbon, have really led the green bond use of proceeds worldwide in 2019 and previously as well. So again, just highlighting Fannie Mae, they've used their green bond issuances to support the retrofitting of U.S. rental properties to become more energy and water efficient. In 2018 alone, they issued over $20 billion, primarily to finance energy efficiency. In the social bond market, the city of Los Angeles in 2018 was the largest global municipal issuer of a social bond, committing to invest $276 million in housing for the homeless, including facilities for mental health services and drug and alcohol treatment, education and job training. So again, there's a really broad application of these types of investments. Great, we can skip ahead to the next slide. The UN Sustainable Development Goals are increasingly accepted and applied within the impact investment community. And for those who are not so familiar with the SDGs, they're a universal call to action to end poverty, protect the planet, and improve the lives and prospects of everyone everywhere. The 17 goals were adopted by all UN member states in 2015 as part of the 2030 Agenda for Sustainable Development, which set out a 15-year plan to achieve the goals. Achieving the Sustainable Development Goals, including deep decarbonization, requires an economy-wide transition that extends beyond business, traditional business models and kind of the traditional acceptance of green. This will contribute to the diversification of project types acceptable in the labeled bond market. And the SDGs most commonly reported to date have been SDG 7, so affordable and clean energy, SDG 11, sustainable cities and communities, and SDG 13, climate action. But again, as we see the needs of cities and states evolving and moving towards a kind of a deeper decarbonization, I think we'll see more SDGs being pulled in and reported on. Great, we can move ahead. So briefly before we touched on the external review process, the green bond principles and the social bond principles recommend that issuers obtain an external review to confirm the alignment of their bond framework with the four core components of the principles. So external reviews are an independent party confirming alignment with the bond principles. And the most common forms of external review are assurance, which is a confirmation of compliance with the bond principles, kind of the most simple. A second party opinion, or an SPO, which is an assessment of the issuer's alignment with the bond framework and confirming compliance with their bond framework against the principles. There's green and social bond rating and evaluation, which is an evaluation against a third-party rating methodology, which considers the environmental and social aspects of the investment separately from the credit ratings. And then lastly, there's the verification for certified climate bonds. This is a third-party verification, pre and post assurance of the bond, and confirming that the assets adhere to the climate bond standard. And the climate bond standard is a labeling scheme for bonds, ensuring that they support projects that have outcomes that are consistent with the 2 degrees Celsius warming limit set out in the Paris Agreement. Pretty high level overview, but there's more information on that on the ICMA website as well. And then we can just skip ahead. So just to kind of wrap up, and I think, we can kind of touch on this more during the Q&A, but, I think is there an opportunity for mission-driven financial institutions? And I think that the answer is a resounding yes. Our collective responsibility, as stated in the IPCC report, the most recent one published in 2018, and I will just read this aloud, our collective responsibility grows more urgent as mounting evidence demonstrates the global risk that climate change poses to health, livelihoods, food security, water supply, human security, and economic growth. The Organization for Economic Cooperation and Development, OECD, estimates that $6.9 trillion a year is required up to 2030 to meet the global climate and development objectives. And just recently in his annual letter to chief executives, Larry Fink, the CEO of BlackRock, said his firm would avoid investments in companies that present a high sustainability-related risk, fundamentally shifting the asset manager's investing policy. So by strategically addressing and potentially mitigating these risks through the issuance of green bonds and other initiatives, issuers may ultimately be rewarded with a lower cost of capital, while investors will benefit from sustainable long-term returns versus investments in issuers with high levels of climate risk. So I think this is a key factor that's really been driving this market. And I think as we see significant demand for labeled bonds and new issuances, they tend to be overly subscribed, as we'll see today, and that creates the perception, which I think is becoming more of a reality than a perception, of a green bond premium, which is developed, which allows issuers to pay lower yields on bonds carrying a green label versus conventional bonds. And as we'll see today, for mission-driven, CDFIs and other mission-driven organizations, this lower cost of capital can be used to support our mission-driven work and to provide flexible capital solutions to underserved communities, which really, in terms of the work that we do, for example, at CPC, helps in the creation and preservation of affordable housing and the revitalization of communities. So Bettina, I will pass it back over to you. That's a very high level, but I know being conscious of time, we'll want to allow time for the others to present. So back to you, Bettina.
Yeah, thank you, Atalia. That is a ton of information. It's a big, dynamic market, and so I just really appreciate you putting all of that together so succinctly to set the stage. A lot of great data and trends that, as you mentioned several times, we're going to see examples of through individual institutions' experience throughout the rest of the call. So thank you. And I just wanted to ask Liz, are there any specific questions for Atalia before we go on?
There aren't yet.
Okay.
So I think we can go on.
Excellent. Well, then let's turn it over to Christina to hear about Lyft's experience.
Yeah, sure. And good afternoon. And I am going to kind of take you through the logic of why Low Income Investment Fund decided to go to the bond market, a little bit about the decisions about how that was structured, and then the end result. We'll try my best to make it quick. So on the next slide, basically over time, we're a CDFI. We've been around for 35 years. We have a loan portfolio of around 400 million. Over the past 5 years, getting to that 400 million was relatively steady but strong growth, right? So probably in 2015 or so, we had about 150 million. Going to 400 million required us to go out and get more capital, right? And for a while, we were able to use our net assets and some pretty advantageous and low cost capital as the portfolio grew. We're moving out and talking to CRA motivated banks and other financial institutions. We lend to our borrowers at a fixed rate because of our stage of financing. That's really all the project can bear. As we went out to get more capital, a lot of that capital was coming to us at short terms and at floating rates, which really put the interest rate risk management on us because, we put the money out, it's fixed, and we're borrowing money that as rates rise and fall, we're kind of subject to that. And as you can see from this graph, we're starting to really experience some pretty significant decline in interest margin. On the next slide, you can see the debt. So the proportion of our portfolio that had variable rate debt was pretty high. To the tune of around $100 million, which if there were fluctuations in LIBOR, which most of that's based off of, or interest rates went up, we're really on the hook for that. So between the growing volume and our exposure to interest rate risk, we decided to really rethink our overall capital strategy. Next slide, sorry. So we went to S&P to get an issuer rating for the organization, and we weren't necessarily exactly sure how we would leverage that, but we knew it was a step in the direction of accessing the capital markets and kind of moving beyond our traditional relationship lenders, which we obviously still need to keep the ship moving, but our growth and the things I just described, we wanted to kind of add to our diversification of debt. Next slide, please. So what we decided to do very shortly after getting an investment grade rating from S&P was to go straight to the capital markets. And so we did an RFP. We identified an underwriter, which was Morgan Stanley, and also a co-underwriter, the JP Morgan Chase. We pulled together a bond issuance team, which I'll spare you the details of which, but it's quite an assemblage of people. You've got your counsel, the underwriters council, and it goes on from there. So we pulled everybody together. And we pulled together an offering memorandum and an investor roadshow, which just is basically the presentation with which you try to sell bonds to people that might buy them. Some of the major structuring considerations that we had to really think about as we went through the process I very quickly just described is, did we want to designate this as a sustainability bond? And with the highlight on green, we decided that we did, but there's one of the considerations on it is it's very difficult to get that designation when you're not doing a refinance of debt. And for a while we were like, well, we want to refinance our floating rate debt, but we might want some new debt to use for new loan originations. But given the fact that we really thought that getting this bond designated as a sustainability bond would be attractive to investors, we decided to do a full refinance. We also added the UN SDG goals and decided in the process at the suggestion of our underwriter to get a third-party validation of both of those things. And we got that validation from Sustainalytics, who kind of came in and looked at our portfolio that we were proposing to refinance and really the framework of our investment decision making about what loans we do and the parameters around those loans, which is really quite interesting for us because we're very used to reporting impact and that type of information we're very used to providing, but being able to articulate it in a framework was new, but turns out, in reality, the portfolio that we were talking about really hit all of the bullet points that Sustainalytics wanted to see. We also had to think about what type of bond structure we want. Do we want it fully amortizing? Do we want balloon payments? How long a term do we want? And what do we want to agree to have to disclose on a going forward basis for the life of the bonds? And a lot of that is a bit of dancing between who's proposing to buy your bonds, the underwriter, and what works for the organization. And, you know, for example, Sustainalytics was really looking for us to agree for the 10 years of, you know, bonds that we were going to try to sell, to provide disclosures on an annual basis to the bondholders on, you know, where those funds are being used. We ultimately decided not to do that, just because, you know, there's a lot of work in that, and it's pretty early days of this type of designation and the third-party validation. And we felt like, you know, we do the types of loans we do. We've outlined our framework, and the loans that we are refinancing at the time of this transaction very well fit in that framework. Next slide, please. Really quickly, I'm not going to talk about this much, but to say, you know, it's a substantial amount of work to pull off one of these transactions, and it requires a lot of internal resources as well as external. But, you know, when you think about how terrible your life is, it's really only, you know, a month and a half or 2 months or maybe 3. And you can kind of see that from this timeline. We started at the end of May and had the money in hand by the end of July. Next slide. So those bonds that we sold, it was $100 million refinance. The way that we structured it was essentially it was 2 bonds with balloon payments of $25 million a year in years 7 through 10. So the weighted average maturity of that debt was almost 8.5 years. We were able to get away with no financial covenants, which was really important to us. And we were, you know, told by our underwriter we were probably going to pay a premium for that, which we were willing to do. The main highlight here to me, or what I was very surprised about, was the fact we were selling $100 million and we had $1 billion of orders in the book. And because of that, we were able to push down our spreads, you know, our overall pricing. But even within that 10 times oversubscription, we were able to identify about $400 million that we could directly link to institutional investors that were motivated by ESG and the fact that this was designated a sustainability bond. It could be higher than $400 million, but that was what we're able to like clearly identify. You know, you can see the credit spreads there. I mean, you'll hear from CPC in a little bit they were able to tighten those spreads quite a bit, but at the time, this was a huge victory for us. We had an all-in cost of 3.81%, which really, for 10-year money, was a fabulous win for the organization. Next slide, please. So this is just really quick snapshot of the transaction. At the top, you can see we got $100 million, but some of that never even reached our bank account because there's significant transaction costs associated with a transaction of this size. And then in the second box below, you can see our cost of funds on the debt refinance was over 4%, and the tenor was even shorter, you know, than post-bond, where we weren't even intending on having experience of savings. We were really just looking to break even on it. But not only were we able to experience a savings on our cost of funds, we were also able to extend the tenor of our debt. And then my last slide, in conclusion, is just, you know, it was a tremendous win for the organization. We were able to eliminate a bunch of floating rate risk and therefore interest rate risk. We were able to better asset liability match our receivables given the longer tenor of the debt. We left without any restrictions on how we could use that capital post-transaction. And most importantly of all, is we're able to diversify our sources of capital as we grow. Any questions out there?
Thanks, Christina. I feel like I was on a roller coaster of emotion when you said that your life is going to be terrible, and that was kind of a low point, and then you ended on all these benefits. So I'm glad that we came around to that. But yeah, I think there is a hand raised. Do you see who that is, Liz?
Actually, there is a hand raised and also a question. And the question is, how did you price the sustainability designation of the bond.
Well, I mean, that's tricky. I mean, it's a very tricky question in that. So we were the lowest rated to date, like S&P rated CDFI to go to market, and the first to go to market after there was some market disruption. And so, you know, we were a little concerned about the pricing, which is why we did an RFP with with a series of investment banks, some of which were very clear they thought sustainability bond would add to the marketing, and some didn't mention it at all. But we were really, one of the big components of the investment bank relationships that we chose was their marketing strategy. And their ability to reach a lot of investors, because ultimately the more demand you get, right, the better pricing you're going to get. But given our mission and what we're able to say and target on the ESG side, we always were expecting that to be a component of our marketing and our value add in the market, because at the end of the day, CDFIs are a new asset class. We are paying, you know, we are paying more for that, right, than like another A- issuance that comes to market on the same day, but this more established asset class is going to get a better cost of funds. And so it's not a direct link to me. I can't say like we got better pricing because of sustainability directly, but I can say the sustainability designation contributed to the oversubscription, which then allowed us to drive down pricing.
Okay, Adam, I hope, or sorry, Renee, I hope that answered your question.
And Liz, are you able to unmute the person with their hand raised as well?
Sorry, the person who had your hand raised, can you please raise it again?
Or maybe they had a similar question.
Maybe they did. Yeah, the hand is now not up. So I think we can move on.
Okay.
Yeah.
Great. Well, thank you so much for that. And this leads us really nicely into Anna from LISC. Christina mentioned a whole bunch of considerations that they were thinking about as they were going through their issuance. And Anna, I think you're going to help us think through a couple of those.
Yeah, great. Can everyone hear me?
Mm-hmm.
Great. So LISC was the first CDFI to issue a sustainability bond in 2017. However, our bond at the time, we did not get a second party opinion. And I think that that's something that we've really seen a proliferation of in the last couple of years. So of the 9 CDFIs that have gone to market, 5 have been designated sustainability bonds, and 3 of those have received second party opinions. Though other ones, there's some that were called impact investment bonds and one that was called a community investment bond. But sustainability bond is the only one that has some kind of broader framework that it's aligning to. And I think that that's something that is going to be really interesting as the industry continues to grow, to be able to, as Christina said, you know, target people who do know this designation and may not be familiar with the CDFI asset class. I think it's just another kind of tool in our toolkit to better educate people around how we designate use of proceeds through our bonds into the projects that serve our communities. So I did put a little bit about our inaugural sustainability bond. Nothing that crazy. I feel like essentially Christina's presentation has been done for LISC as well. It's the same story kind of around why we went to the market to get lower cost, longer term capital without geographic restrictions. I did put in a little bit around our sustainability bond framework, and one thing that I do think I want to tease out a little bit more is the point around how having the use of proceeds for sustainability bond, how it might be better suited for a refinance versus new loan proceeds. Because I think one thing that you're able to do with refinance is pull out the specific loans that you're going to be refinanced with that debt so people can see how those projects align to your sustainability bond framework. So in our Appendix A of our bond issuance, you can go through and see what loans LISC specifically called out as being refinanced through the proceeds of our framework. And one thing that is LISC has a variety of asset classes that we finance, but we can't say with comfort that every single loan that we finance has a sustainability component to it. So I think having the ability for refi allowed us to specifically identify the loans that would fit within that framework. I think as you're looking through whether or not you're going to pick a green, social, or sustainability bond, that's something that you can think about. And potentially the social bond framework, I believe, is a lot broader for CDFI, since almost all of our missions are chartered to serve low to moderate income communities. So I would be shocked if we did not all fit within that with the way that we fund our loans. And one thing that I was going to mention is LISC is pursuing a retail note program that aligns with the social bond framework and the UN SDGs. However, information is not publicly available yet, but that was one consideration that we had, is how we could pursue some kind of third-party designation for new loan proceeds. And then the next slide is kind of repetitive, so I don't think I need to go that far into it. And I know we are a little bumping up in time, want to leave some more time for Melanie and for Q&A, but one thing that I did want to touch on too is, to date, for CDFI, Sustainalytics has been the only second-party opinion provider, but there are other ones that exist out there, including the other two large ones. One is called Cicero, and one is called Vigeo Eiris. Vigeo Eiris was bought by Moody's in 2019, I believe, and so they're going to try to, I believe, combine practices with some of Moody's general reporting around green and social and sustainability bonds. I would recommend kind of sussing out what second party opinion provider might be the best fit for you and what you're trying to achieve with your bond issuance. And on the ICMA's website, there is a database of the different types of bonds, as well as links to both the bond framework that people have developed, as well as the second party opinion. And I think that can really help you define your own framework. And the second party opinion providers can also help flesh out some of the terms and ways to kind of communicate the impact that you are making in your communities that might not be as common to people who are not within the CDFI industry. I don't know what else I was going to talk about. Sustainalytics is still the largest of all of the raters. So that, I think, is one of the reasons why the CDFI market has gone to them thus far. But I would also say that this whole world is getting a lot more traction. I think there was a report that came out a couple weeks ago that said that Sustainalytics has provided 400 second party opinions, and almost 200 of those were in 2019. So I do feel like there's a lot of growth in the market that we'll be seeing over the next couple of years. And I think that CDFIs are really well positioned to be major players within both the sustainability and social bond space. I am going to pause there. I know that was kind of a lot of information at once, but I want to, again, provide more opportunity for the rest of the speakers.
Thanks, Anna. That's really helpful. It's interesting how LISC's journey seems to be kind of reflective of changes happening more broadly in the space with labeling. And thanks for the ICMA website heads up. I know Atalia mentioned that as well, and we can include that in the follow-up along with the report that you mentioned, since that was a lot of information. Before going to Melanie, who's going to bring us home, Liz, any questions or hands?
Yeah, Renee was asking this more specifically. How much Sustainalytics charged for the designation of the bond issues? if either of you are willing to share that.
So there's usually a base price, and then they'll charge more depending on how many categories you include. So there's like usually a base price, and then if my screen is still up, so like if you had all 10 of the green project categories and like all 6 of the social project categories, the price would probably go up. I don't remember if we're allowed to publicly disclose how much the pricing was, but it's not, in the grand scheme of all the other costs of your transaction, it's pretty minimal. Christina,
yeah,
do you know?
I found it. I am not sure if I'm allowed to say it, but can I say it's under $20,000? Oh,
Yeah.
That's what I will say. It is, like, that is a fact. I just don't know if I'm allowed to, like, quote, because they may quote differently depending on exactly what Anna just said, the amount of work involved.
Yeah.
But it, given, in the scheme of a transaction of this size, it was relatively nominal.
Yeah. One thing that I would say that I feel like there was a push to, like, have, like, there could be additional costs depending on how you want to report on an annual basis. And that's something that I didn't really talk about, but in LISC's initial sustainability bond, we didn't say any of our reporting would be different from what we already do. So it didn't create an additional reporting burden, but in some cases, issuers will say that they'll do certain things within their framework, and they might commit to having the second party opinion provider come in and validate that they are actually allocating the proceeds as the way that they said that they were going to do. But I don't believe that any of the CDFIs to date have differed their reporting based on the second party opinion.
Thank you. That's great.
All right, well, why don't we move to Atalia and Melanie to hear CPC's experience, and we'll see if we get to one more question at the end.
Great, this is Melanie Crocco from CPC. I'm going to share this presentation with Atalia, who is our head of our sustainability program. So to kick off and give an overview of CPC, in February, so just last month of this year, we raised a $150 million 10-year sustainability bond. And prior to that, we received a rating from S&P of AA- with a stable outlook. To provide a little bit of context on the organization, CPC is one of the largest CDFIs in the country, solely dedicated to investing in multifamily, affordable, sustainable, and workforce housing. We were established in 1974 as a self-sustaining, mission-driven, non-for-profit, multifamily housing and community revitalization finance company. Over our 45-year history, CPC's business model, strategies, and lending have proven successful as we have built a strong financial position and foundation that continues to build our strength and grow our mission. We provide capital solutions that are integral to the creation and preservation of affordable housing in New York State and New York City and beyond. And as a mission-based organization, we have helped to finance over 196,000 units of affordable housing and 7,000 units of energy-efficient housing. As such, as of today, more than 3/4 of our construction portfolio is comprised of loans that are both or sustainable and or affordable, that all meet the characteristics of the sustainability bond guidelines that Atalia walked through previously. So to give a little bit of context on how our sustainability platform is structured, our platform, Bettina, you can skip the page, please. All right. Our platform is integrated within each of our lines of businesses, and it's all aligns with the sustainability bond guidelines. And one thing to note before I hand this over to Italia to go into detail is as we peeled back the onion and really dissected and understood what the sustainability guidelines were, we really took note at how much the infrastructure, the operations, our business, in addition to our portfolio as a whole, aligned with both the social and the environmental impact goals of the guidelines. So in more detail, Italia can walk through those.
So yeah, I'll just kind of cover briefly our sustainability platform. As Melanie mentioned, it's really integrated into every line of business that we have. So just kind of calling out a few of these kind of key initiatives. We just recently announced this week actually that we're committing to achieving carbon neutral operations this calendar year. And really that's a natural step for us, one that aligns with the city and state carbon reduction goals and the mission-driven work that we carry out in communities across the state. We've developed free tools and resources to educate the market about the benefits of energy efficiency and the savings that building owners can achieve through different levels of retrofits. So we have a CPC Verify tool, which is an online application that can be used to calculate utility savings and explore financing options. We have the Underwriting Efficiency Guide, which was published a couple of years ago and provides lenders and public partners. It's a resource to understand how to finance energy and water efficiency measures as part of a first mortgage and how to underwrite those savings. We're developing a supplement to that guide currently where we're focused on high performance, so passive house, net zero energy, and new construction. And, we really partner and we care about what our partners care about. So we're a member of the Carbon Neutral Buildings Roadmap, the Technical Advisory Group, which is NYSERDA's tool they're developing to help the state become carbon neutral by 2050. So again, just a highlight of some of our key initiatives, but really sustainability has really been ingrained in our work for well over a decade now.
Bettina, you can turn the page now. All right, great. So why did CPC pursue a sustainability bond? A lot of the same reasons that LIF and LIST walked through apply to CPC. Our $150 million bond previously noted was priced well under 3% all in. It was 10-year fixed. We were really pleased with the execution when we closed. To take a step back, we are continually looking for ways to raise capital to further our mission in the projects and in the housing that we do. The bond raise was a critical part of our long-term capital strategy for CPC to have access to long-term fixed-rate debt, similar to LISC. Reducing our long-term cost of capital will really help CPC provide additional investments and housings in the community that we serve and that are pressing needs across the communities. Because the market and demand is strong and continues to grow for sustainability bonds, CPC identified it as an opportunity as a capital raising initiative that could easily align with our long-term strategies. We started looking into the guidelines, and upon doing so, as previously noted, we quickly learned that 75% of our portfolio aligned. And what does that mean for us? On a quantitative basis, we looked at the deals and determined that anything that was a green project is an energy efficient housing project that is proven either through the industry or through the certification that the project certified to, and that they would achieve more than 15% in energy savings. For us, the social projects included affordable housing projects where more than half of the units were under 80% AMI. Proceeds of these bonds were used to refinance a portion of this construction portfolio and to reduce our overall cost of capital. Very similar to everything that LISC and LIF has said. Bettina, you can turn the page, and Italia is going to walk through one project as an example for a green project for CPC.
And actually, I'll do that very briefly, just because being conscious of time. But this is just one that we wanted to call out within the portfolio that we applied the sustainability bond to. So this is an affordable housing complex in Rochester, New York, in upstate New York.
31 buildings, 188 apartments. The complex was long overdue for upgrades. They had individual gas furnaces and hot water heaters, and really were lacking energy efficiency systems. And there were moisture problems. So CPC financed a construction loan to finance the energy retrofit for this complex. 1.1 million construction loan that drastically lowered utility bills by moving them to more energy efficiency systems, better lighting, and so in total, based on the renovations, the property reduced gas utility bills by $450 per dwelling unit and saved 24% on the annual utility cost. So these are significant savings that flow through to both the building owner and the tenant, which helps us in our mission to preserve long-term affordability. So again, just one example to highlight.
Bettina, you can turn the page. So we wanted to close with tips and lessons learned, particularly from CPC's bond issuance process. The 5 key areas that we wanted to focus on are the project team, the corporate rating, our second party opinion, documentation, and market and execution. So on the project team, what we found really helpful in our process was that before engaging with the process, it was really critical to CPC to establish a cross-functional team that could be fully engaged in the bond process. Different areas of our organization that included was our finance group, capital raising, legal, accounting was very important to get through the S&P process, project management, and analytics. It also was critical for us in hiring a good and reputable banker to both guide, consult, and underwrite the transaction. And we ensured that that banker was engaged from the beginning of the corporate rating process through execution of the bond, which then that leads into the corporate rating process. Our lessons learned in working with S&P is that the market is still in the very early stages, working with CDFIs and rating CDFIs. The only organization right now looking at CDFIs is S&P, which is not to say that Moody's will eventually engage in this space, but right now it's just S&P. On top of that, no CDFI is the same, or do the same business, or have the same financial structure. So no single approach to evaluating a CDFI could be applied from S&P. This made the corporate rating process a little timely and intensive. So ensure that you prepare time for that. On the second party opinion, CPC had a great experience working with Sustainalytics to receive a second party opinion. In order to issue the bond, a sustainability stamp was highly recommended to attract the investor base that we needed, as mentioned both by Lisk and Lift. Prior to engaging Sustainalytics, we researched the bond guidelines and principles internally and assessed how CPC aligned with the framework. And then we formally established a sustainability bond framework. Once that was in place, we engaged Sustainalytics and worked closely to have the second party opinion in place. On the documentation, it was very crucial and critical for CPC to ensure that we had a complete documentation prior to going to market in a roadshow to ensure, and so we needed to make sure that we allocated sufficient time to do so. Like Lisk and Lift, we authored the Appendix A extensively to cover the organization, our history and structure, operations, lines of business, and financial position. We took a tremendous amount of time and value to ensure that it shed CPC in the way that we wanted it to. Once all of that was in place, which did take some time, the actual execution of the bond raise was one of the simplest and easiest that we've experienced in the capital markets and in all of our capital raising efforts. Of course, it doesn't hurt that the demand for sustainability bonds at the time was growing, but we were really proud of how the execution rolled out. So ensure that, to close, these are 5 areas that we are recommending are considered and completely thought out as part of your process in going through the sustainability bond process. And to that, Bettina, CPC closes and passes to you.
Well, thank you so much, Atalia, and thank you, Melanie. Also Anna and Christina, just for being so transparent and really going so deeply and in detail, even though we've only been together for an hour and that hour is now up. You guys have covered so much. So just thanks for your candidness today and also your leadership in this emerging world of sustainability bonds. Like I said, we are out of time. I know that some people have asked about the slides, and so just want to confirm that I will send around a PDF of these slides that were presented, along with the link to the recording of this session, as well as some links to some resources that have been mentioned today. You should get that tomorrow or early next week. And also, thank you so much, Liz, for managing the questions and co-hosting today. I know that there were some questions that we didn't get to, and just be assured that we're going to take a look at all of those and follow up and make sure that people get their questions answered via email. So with that, thanks again to everyone, and I hope everyone has a great day.
Thanks, everyone. Bye.
Bye.
Thank you.